For 4 decades, the bargain was simple. Germany gave China its most precious industrial secrets, its engineering perfection, its automotive brilliance, its chemical formulas, and in return, China gave Germany unimaginable, endless profit. It was the greatest economic alliance of the modern era. Germany became rich by selling to the Chinese market. China industrialized by learning from the German masters. But that bargain is officially over. The cracks that appeared in Beijing's economy last year, the housing crash, the youth jobless epidemic, the plunging consumer confidence, were manageable. But what is happening now is a structural, systemic failure. And the biggest, most critical foreign players, the German industrial giants, are seeing the writing on the wall. This isn't de-risking. This is a quiet, strategic exodus. We're talking about the titans, BMW, BASF, Siemens, not just pausing investment, but fundamentally changing their global supply chains to run around China. This is the story of how China's economic model, built on relentless growth and foreign dependence, just fundamentally cracked. And why the flight of German capital signals the end of the Chinese economic miracle as we know it. Why Germany? Because no other G7 nation had a deeper, more intertwined relationship with Beijing. For the German economy, China wasn't just a market, it was the engine room. German automakers alone accounted for nearly 2/3 of Germany's total investment in China over the last 4 years, totaling billions of euros. Take the automotive sector. For years, every major German brand, Volkswagen, BMW, Mercedes-Benz, viewed China as their guaranteed growth engine. But look at the numbers. In the first 3 quarters of 2024, deliveries by all 3 German auto giants fell by an average of 12%, while the overall Chinese car market still managed to grow by 3%. Why? Because the market shifted overnight to new energy vehicles, NEVs, electric and hybrid, and the German giants were simply too slow. Local Chinese competitors, heavily subsidized by Beijing, are now dominating. Foreign market share has plummeted from 62% in 2020 to around 36% in late 2024. The painful realization? German engineering doesn't guarantee a premium price anymore. The initial response from giants like VW and BMW was to double down, pouring billions more into R&D and production in China. But this isn't confidence. This is a risky bet on a mirage, the hope of reviving past glory. And crucially, smaller, more nimble German firms are not making that bet. They are the canary in the coal mine. It's not just cars. Look at BASF, the world's largest chemical producer. BASF built a $10 billion smart chemical complex in Zhanjiang, a monumental symbol of German faith in China. They are doubling down, yes, but at the same time, they are quietly ramping up operations in India and, most significantly, Vietnam. This shift is the definition of de-risking. It's not a full exit yet, but it's the calculated move of a company saying, we cannot put 100% of our global eggs in a basket that Beijing can simply pick up and shake. They are setting up parallel supply lines, a clear, pragmatic hedge against geopolitical shock. For industrial behemoths like Siemens, the issue isn't just market demand, it's the regulatory environment. Germany's highly sophisticated machinery and electronics require constant data transfer and access. But China's new anti-espionage law has turned routine business intelligence, market research, and even simple data sharing into potential felonies. The law's definition of espionage is so broad and ambiguous, including any documents, data, materials, or items related to national security and interests, that collecting competitor pricing or analyzing market trends can now be viewed as a threat. This creates an environment of extreme compliance risk that no Western board is willing to accept. When the cost of simply doing business includes the constant threat of having your employees detained or your data seized, the risk premium becomes infinite. The German industrial flight is a reaction to a deeper, more profound problem. The foundation of the Chinese consumer economy has cracked. We have to start with property. Real estate isn't just an investment in China, it's the national savings account. Roughly 70% of Chinese household wealth is tied up in the housing market. When giants like Evergrande and Country Garden collapsed, they didn't just default on corporate debt. They destroyed consumer confidence on a generational scale. Imagine waking up to find 2/3 of your retirement savings, the value of your home, vaporized. The result is a mass psychological shift. Chinese consumers are hoarding cash. They are not buying new cars, they are not upgrading appliances, and they are not spending on luxury goods. They are waiting for the next shoe to drop. This lack of demand leads directly to the single most dangerous macroeconomic threat China faces: deflation. While the West grappled with inflation, China is fighting falling prices. The Consumer Price Index, CPI, has hovered near zero or dipped into the negative for much of the last 2 years. Even worse is the Producer Price Index, PPI, which tracks factory gate prices. It has been negative for over 30 straight months. What does a negative PPI mean? It means Chinese factories are making products and selling them for less than it costs to make them. This is industrial overcapacity in its purest, most destructive form. It forces massive debt defaults, cuts worker wages, and further suppresses consumer confidence, creating a self-reinforcing, inescapable deflationary spiral. Fueling this crisis is the generational bomb: youth unemployment. The official data, which was hidden for a time, and then resumed using a new, narrower methodology, still shows the youth jobless rate, ages 16 to 24, bouncing around 15.2%. And if we use the old, broader metrics, analysts suggest the true rate for college-educated graduates is much higher. These are the people who were supposed to be the driving force of the consumer economy. Instead, they are financially paralyzed, unable to get jobs that match their skills, and forced to rely on their parents. This is a permanent loss of future consumption power, and it is a direct result of Beijing's policies that prioritize state-led manufacturing over a healthy, consumer-driven service sector. The German firms leaving are simply confirming that the next generation of Chinese buyers won't be able to afford their premium products. Why is this crisis happening now, despite the best efforts of the Communist Party? Because every policy decision for the last 5 years has pushed foreign capital away. While the world remembers the lockdowns of 2020, foreign investors remember the complete, sudden supply chain shock of 2022. Entire cities, like Shenzhen, were shut down overnight, paralyzing production. This wasn't just a health measure. It was a demonstration of the CCP's absolute power. It showed CEOs that their multi-billion-dollar factories could be rendered useless by a single, unchecked provincial party official. This shock forced every major global company to implement a China plus 1 foot strategy, a mandate to build alternative production bases outside of China. It was the first structural nail in the coffin. We already touched on the anti-espionage law, but its scope is worth underscoring. It is not an abstract legal risk. Authorities have conducted raids on major foreign consultancies and due diligence firms, companies like Bain & Company and Mintz Group. These are the intelligence agents for foreign businesses, the people hired to figure out who they should partner with and what the market risk is. By targeting them, Beijing is sending a clear message: we control the information. Your ability to conduct basic due diligence is terminated. When foreign investors can no longer accurately gauge financial, legal, or political risk, they simply withdraw. The lack of reliable information is as effective a barrier as a 100% tariff. Remember the regulatory crackdown on Chinese tech giants? The sudden cancellation of the Ant Group IPO, the forced restructuring of Alibaba, the devastating attack on the private education sector, like New Oriental? This showed foreign investors that no sector is safe. Beijing can and will prioritize political control over economic prosperity whenever it feels the need. If the CCP can kneecap its own homegrown champions in the name of political purity, what chance does a German subsidiary have? This uncertainty has led to a sharp decline in capital expenditure across the board. The message is clear. The rules of the game can change at any time, without warning, and based solely on the whims of the party leadership. Above all the economic data and regulatory hurdles sits the immovable object: geopolitics. Every German board meeting today involves a discussion of the Taiwan risk. The war in Ukraine was a profound wake-up call for Europe. It exposed the danger of dependency on an autocratic regime for essential resources. Germany, in particular, was burned by its reliance on Russian natural gas. Now, they look at China, where their entire advanced manufacturing base relies on Chinese parts, rare earth minerals, and the market itself. If Beijing were to take hostile action against Taiwan, the U.S. and its allies would impose a sanctions package that would make the Russian sanctions look like a parking ticket. German companies cannot survive being cut off from the global dollar system or their primary market. Therefore, the only logical step is to preempt that risk. This isn't just commercial prudence, it's national strategic imperative. Beijing, for its part, is accelerating its dual circulation strategy. In simple terms, China wants to rely less on the world for technology and more on itself for demand, while making the rest of the world more reliant on Chinese manufacturing. This has a critical implication for German firms. China wants their technology and their factories, but it doesn't want their influence or their profits going abroad. The state is actively supporting local champions to displace foreign firms, especially in high-tech fields like EVs and robotics. The foreign investor is no longer a valued partner. They are a temporary training service to bring Chinese competitors up to speed. The ultimate evidence of this geopolitical and regulatory fear is the single most shocking statistic of the year: the foreign direct investment, FDI, crash. For the first time since the data was recorded, China's FDI net inflow went negative in the third quarter of 2023. Not a drop, an outflow. This means more foreign capital was pulled out of China than was reinvested. Data for 2024 has shown continued weakness, with total FDI plunging by over 27% year-on-year in recent reports. This is not a temporary blip. This is a structural rejection of China by global capital. Investors are not just avoiding new projects. They are actively liquidating existing assets and moving the money out of the country. This money, billions of dollars, is now flowing into Vietnam, India, Mexico, and Central Europe, building the alternative supply chains that German giants need. What does the German flight mean for the rest of the world? It means the decoupling everyone talked about is no longer theoretical. It's a quiet, profitable reality. For Germany itself, the shock is immense. Its political leaders are now actively encouraging diversification. Chancellor Friedrich Merz has publicly warned German CEOs that if their investments in China go sour due to geopolitical events, Berlin will not bail them out. This is a complete reversal of the previous policy of unconditional engagement. It means the German government is forcing companies to internalize the risk premium, pushing the private sector to do what the government couldn't mandate: reduce exposure to Beijing. The next decade will see a fundamental restructuring of Germany's industrial base, as production and profits shift closer to home or to politically stable partners. The winners of this German exodus will be the economies in Southeast Asia and the Americas. Vietnam, Thailand, Mexico, and Poland are seeing massive influxes of manufacturing capital. These nations offer relative political stability, proximity to Western markets, and lower geopolitical risk. This shift will not just replicate China's manufacturing capacity. It will fundamentally fragment the global production system. While this fragmentation makes goods more expensive in the short term, it makes the global economy more resilient to the kind of unilateral supply shock that Beijing demonstrated with zero COVID. How is Beijing responding? With more of the same. They are increasing state subsidies to local firms, doubling down on the military-industrial complex, and resorting to extreme monetary easing to prop up zombie companies. They are sacrificing the financial stability of the private sector and the confidence of foreign capital to maintain the illusion of political control. The truth is, their structural problems, the debt, the demographics, the rigid political system, are not fixable with a simple stimulus package. They are systemic, and the flight of the German industrial heartland proves that the patient is terminal. The German giants were the last holdouts, the ones who kept faith in the Chinese economic model longer than anyone else. Their quiet retreat is the loudest confirmation yet. China's economy has structurally cracked. It is no longer a growth story, it is a risk mitigation story. The question now isn't about if the world can thrive without China, but how fast the rest of the world can build the infrastructure to replace it. And that brings us to the next massive challenge. As China exports its deflationary overcapacity, selling cheap goods at a loss to the world, which major Western industrial power will be the first to face a catastrophic wave of Chinese competition? In my next video, I'm going to break down the 5 European industrial sectors that are on the verge of collapse due to China's exporting deflation strategy. If you want to understand which industries are about to be flooded with cheap subsidized Chinese goods and which companies wouldn't survive the year, make sure you hit the subscribe button right now and turn on notifications so you don't miss that crucial analysis. And tell me in the comments, if you were the CEO of BMW, would you be pouring billions more into China, or would you be betting everything on Mexico and the US market? Click here to subscribe, and I'll see you in the next video.